Hi, everybody. I'm Mary Claire Speckner with the library. And tonight's program is Why Smart People Do Dumb Stuff with Money. And our presenter is Jalene Hahn, who's presented for us many times over the many years we've been doing programming at the library. Jalene has a passion for helping people put money in the context of life. She writes a monthly column for the Indianapolis Business Journal and is a frequent speaker on financial literacy and investing topics, like she's done for us. Jalene earned a certified financial planner designation in 2008 and is a fee-only financial planner. Jalene is a member of the National Association of Personal Financial Advisors and the Financial Planning Association. She and her husband Mike have raised 2 boys, Chris and Alex, and in her spare time she likes to read, yay, and has been a member of the St. Bartholomew Choir. She's looking forward to resuming travel again, as we all are. And now over to you, Jalene.
Thanks, Mary Claire. Well, it's good to be here. I see a few faces, a few familiar faces. Welcome. I told Mary Claire this is a presentation that I have wanted to do for quite a while, and her impetus just made it happen. So why do smart people do dumb stuff with money? We can't help ourselves. We are evolutionary programmed to take shortcuts. Our brain's wired for expediency, and it's not always rational. And so what's coming out of the research is this irrational underpinning is behavioral finance. So it's the intersection between psychology and how we act and finance. And it's a really cool field. And I love the topic. So behavioral finance, it's the study of the psychological influences on the behavior of investors and financial analysts. And it's attempts to understand why we behave the way we do with money. Explains our irrational market movements, because sometimes you look at the market and you say, well, that makes no sense at all. Behavioral finance is at work. So there's kind of 2 schools of thought. One is the traditional finance theory, which is what I was raised with, and then behavioral finance. So understanding the traditional finance is think rationality. So the financial markets are efficient, investors make rational decisions, all the participants are sophisticated, everybody has the same information and makes optimal choices. So that's traditional finance, and it comes out of some studies in the 50s and 60s by Eugene Fama from the University of Chicago. He actually won a Nobel Prize for this. And so some of the words that you may have heard with this are modern portfolio theory, the capital asset pricing model, the efficient market hypothesis. So rational, efficient models. And then comes along behavioral finance. This is coming out of research that started in the 70s. So it's new. And it looks at investors are considered normal, but not rational. So we all have these things. We have limits to our self-control. We look at the world through different lenses, and we process information differently. So we make errors in our thought process, and we behave irrationally. So that's kind of the theory of behavioral finance. So think of traditional finance as the theory, and then behavioral finance looks at what really happens. And so you've kind of got to use them together to work through this. So basic types of biases. You have heuristics, which are the shortcuts or the rules of thumb. I see a tiger coming at me. He's going to eat me. I need to run. I think that just because I'm programmed that way. Cognitive is faulty reasoning. So, and finance is full of statistics and information overload. And sometimes our memory goes, especially as we get older. So those are the cognitive errors. And those are a little bit easier to overcome if you have more information or better advice. And then you have the emotional biases, which get us all into trouble. So these are the feelings and perceptions, your beliefs about certain elements, the relationships between them. And they can be a function of reality, or they can be a function of your imagination. And these types of biases are more difficult to overcome. I'm not going to go through all of them, but one article that I was reading said that there are over 50 identified cognitive and emotional biases. That's a lot. So we're just going to look at kind of a few in the different categories. So we have heuristics. An example of those are, and I'll go into detail a little bit later, but anchoring. So the first piece of information that you have anchors your thought process. Availability is you're scrolling through Facebook, you're seeing stuff on Twitter, it's showing up in your Google News feed. So it's that availability, the easily accessible information. And then the similarity is, I've seen this before, I know what I'm doing. Cognitive are examples of that are framing, and how you frame a decision, how you put choices out there can sway people one way or the other. Mental accounting is you have buckets in your mind. So for example, I get cash back on my Discover. It's tied into my Amazon account. So if I want something and I use my Discover points, I'm not spending any money. So that's mental accounting. Overconfidence. I have an edge that you and nobody else has, and I am so good at what I do, I don't make mistakes. So that's the overconfidence part. And then you get into the emotional biases. These are, sometimes it's called self-control, and a lot of the literature talks about it just being lack of discipline. I think that's a little harsh, because we really are evolutionary wired to favor current consumption over future consumption. So we're really geared towards the here and now. And so, yes, it's self-control, but it's beyond that. Again, the emotional biases are the ones that are harder to overcome. And then hurting is groupthink, or that fear of missing out. So everybody else is doing it. And then the paradox of choice is, I call it kind of analysis paralysis, or too many choices. And then we talked about some of the things that you do can fit into multiple categories. For example, when people are looking at stocks and the market, and they're looking at the FANG, which is the Facebook, Apple, Amazon, Netflix, and Alphabet, which is really Google. You hear a lot of information about that, and there's a lot of coverage about those. So that leads to availability bias. Their past performance and some of their fundamentals, you can compare those to lesser known stocks. So that gets into your similarity. When you're talking about, we're in bubbles. So are we really in a bubble, or is it really different now? So those are some of the things that pop into that. So a little more detail. Anchoring. We rely too heavily on the first piece of information that we receive. A lot of this is retail, shopping, clothes. it's that first reference point. So if I'm looking at a pair of shoes and they're $199, I'm probably not going to buy that pair of shoes because I'm not a shoe fiend. But if I see that they're on sale for $199 and they used to be $500, boy, I'm getting a bargain. So I might very well go ahead and buy those shoes. One example is there was a commercial for life insurance policies, and a $500,000 life policy would cost $27 per month. But that's not what the announcer says at first. He asks, how much do you think the $500,000 policy would cost? 100 a month? 75? 50? Actually, he gets this policy for $27. You've been framed, or you've been anchored at that 100. So the 27 doesn't sound that bad. The other thing is when you're looking at stocks, if you've got a stock that's trading for, normally in their category, they trade between $50 and $75, and they're trading now at $25 a share, you're thinking, ooh, this is probably a good price because it's trading out of its norm. And if you don't do a little bit more research, you would be you might miss the reason why it's on sale. The other one, and this gets into a couple of other things, is Kohl's sales. So you go into Kohl's and it's got this price tag there, and you see that, and then you see the sale. And oh, let's throw in a mental accounting with the use of Kohl's cash. So those are some of the things that behavioral finance takes into consideration. Availability is a little bit like anchoring, but it's broader. So availability is, like I said, you're getting things on LinkedIn and Facebook and Google and Twitter. And so people are talking about things. And you're going to get your knowledge whatever's easiest. So for me, I might go to Wirecutter or Consumer Reports to figure out what I'm going to buy. Others, what are your parents and your friends and your coworkers doing? There's other things, it used to be house flipping was the thing. So people were talking about how much money they were making flipping houses. So everybody's thinking, well, everybody's making money flipping houses. I can do that. You don't hear as much of that anymore, but that's the availability. So you're getting a steady stream of information, and you're not always going out to check whether it's reliable information or if there's another side to it. Similarity is we peg things based on what we know. So if it looks like a duck and it quacks like a duck, it's a duck, but it may not be a mallard. It may be some other, like a wood duck, but it's still a duck. This helps us judge quickly. So one of the things is we're now in this FANG bubble. So those stocks have really, really, really accelerated and outperformed. So people are saying, are we in another tech bubble? Is this going to be like 2000? And they're not going the next step down to say, are the fundamentals the same or are they different? Is it okay to go ahead and do these stocks have more room to run, or are they going to crash and burn? So that's the similarity, is I've seen this before. I know how it works. Framing is the other. How information is presented. One of them is the stock market crashes. Most people go, oh my gosh, the stock market crashes. I need to move to safety. I need to sell my stocks. Other people are, the stock market's crashed. Awesome. Things are on sale. I need to put more money into the market. So it's the same statistics. It's just how you look at it. And usually if things are framed positively, you'll head for the positive things. And the differences, the magnitude and the changes of them accelerate that as well. Mental accounting, we've talked about a little this, but you put different values on money that comes from different areas. So if you get birthday money, it may be different than, like I said, my Amazon account, or we all got stimulus checks. Well, that's bonus money. So we may be more frivolous with those. Other people may be more conservative. Some people will have Christmas accounts. So you set this apart, and some of the banks are doing it where you've got an individual account and you divide it into different buckets of money on how you're going to use them. You still have all the same money. It's just how you've earmarked them that you may think differently about them. So that's the mental accounting. And it's kind of fun. Overconfidence. This is kind of said, people have an unwarranted faith in their own intuitive reasoning, judgments, and cognitive abilities. And unfortunately, we see this more in men than we do in women. There's two types of overconfidence. One is your prediction of confidence, and then the certainty of overconfidence. So this bias tends to make you take more risks. It gives us an inflated sense of our judgments. And one of the things to counteract this is to keep a scorecard. So if you're investing in stocks, well, how are they really performing? And for every one that you're hitting out of the park, do you have 5 that are failing? And you just remember that one that you're hitting out of the park. So it's thinking about what level am I really performing at? What is it? Garrison Keillor says all the children are above average. Well, they did a study of mutual fund managers, and 74% of them said that they were above average. That doesn't happen. And then we get into our present focused procrastination, our self-control bias. We all want things now. We're in a culture of instant gratification, and the future is so far off that it's hard for us to be patient and disciplined to do the things that we need to do to get to where we need to go. One of the things that really highlights this is in the 1950s, they did a marshmallow experiment, and they asked children to come in, and they could either choose a marshmallow now, or they could wait 15 to 20 minutes and they'd get 2 marshmallows. Well, they followed these children, and the ones that could delay the gratification at a young age were more successful later in life. And yes, this can be learned. I'm a big proponent of something called cognitive behavioral therapy, and I use it in my diet. So I'll get hungry, or I'll think I'm hungry, and it's like normally I would just go and get something to eat. But with this, it's kind of like, no, I have a snack planned for another 2 hours. I'm not going to die in 2 hours if I don't eat, so I can wait 2 hours. So those are some of the things that we can put into place. bah, are hurting, or FOMO, fear of missing out. So everybody's doing it. I should get in on it. A lot of it right now are Bitcoin, um, electric vehicles. We've had a lot of clients ask us, how do I get in on this electric vehicle thing? The FANG stocks, and not so much now as it was before, is the cannabis exchange traded funds. So I want to buy me some of those cannabis things. So you'll get fads, and you don't really think about the depth of it. I was at a conference once, and it was technology, and they were talking about this one risk tolerance software, and I have a bias against it, and I know, because it's the in thing and everybody loves it. And there's another one that's scientifically based, which is more what I would go with. So I said something to the presenter about, yeah, if I went with this, I'd rather go to court if somebody sued me and have this scientifically one. And he said, well, everybody seems to use this one, so it's the industry standard, so there's nothing wrong with it. And I'm just going, I don't think so. So, but again, it's that fear of missing out. Everybody's doing it. I'm going to do it as well. The paradox of choice. We think about having a lot of choices gives us more freedom and more happiness, but it doesn't always work out that way. It can actually lead to anxiety, indecision, that analysis paralysis. If I just have one more piece of data, it's going to work out. And then after you make your choice, did I make the right choice? In 2000, one of the researchers did what I call the jam experiment. And on a regular day at a grocery store, they had a display with 24 different types of jams. Then on another day at the same store, they had a display with 6 different kinds of jams. The day with the 6 jams outsold the 24 jams because it was easier for people to make a decision. And in finance, we have a lot of products out there. There's a lot of stocks, there's a lot of mutual funds, you have annuities and bonds and life insurance. And these are complicated products. So there's a lot of moving parts to them. There's a lot of data, and it is so easy to get overwhelmed with choice that you put the decisions off, you procrastinate, you don't, and then you're stressed because, my gosh, I made the wrong choice. And again, this is a personal, my new associate advisor and I were talking about it, and there's 2 kinds of thoughts. There's the maximizers that will get every single piece of information, and they research and pull things together. And then you have the satisficers, which will get just enough information to make a good enough choice. It may not be optimal, but by doing the extra research and work to get optimal, is that a good trade-off? So sometimes it's just go with it. So, okay, we've talked about these heuristics and biases. So how can you make smart money choices? And the very number one thing to do is focus on the process. So there's kind of 2 approaches to decision making. The reflexive, going with your gut. It's effortless, automatic, and it's usually what we default to. And then the other is more reflective. So it's logical and methodical, and you really have to engage in it and think. So relying on those what's easy may not always be in your best interest. And so before you take action, you put a pause in there before making a decision. And sometimes no action is the best action. And focus on what the process is rather than the outcome. And so Warren Buffett had a quote. He said, once you have ordinary intelligence, then what you need is the temperament to control urges that get you into trouble. And the basic of that is you prepare, you plan, and you make a pre-commitment. So for example, I had clients that were heavily invested in commons. Imagine that. So we said, okay, you have too much in commons. We're going to, at this price point, we're going to sell a third. And if it goes up to this, we'll sell a third. If it goes down to this, we'll sell a third. And so that was the discipline that we put in place. And so when it hit that price, we had made a commitment and we executed it rather than saying, oh man, it's gone up, it's gone up. Of course, my clients would have liked for me to hang on to it longer, but I don't believe in overconcentration. So you make a plan and you stick with it. Some of the other things that you can do are getting to know yourself. What are your tendencies? And like I said, my mental accounting is if I'm buying it on Amazon and I'm using Discover points, it's free. So I know that's part of me. Panic selling. So last year really tested a lot of investors, and it tested a lot of my clients as well, because the market went down so fast, so far, and we've planned for market dips. We just need to stay invested and stick to the discipline that we have in place. So you don't dwell on the past. Gee, I should have, could have, would have. It's looking at your long-term goals and your time horizon, and then consult with your financial representative regularly. They can kind of step in and help you take some of the emotion out of it. But you also have to realize that we are human as well. And we have our shortcuts and our own biases. So what process did they put in place to pick investments? Did they have systems that counteract their own biases? So look at the process that they go through rather than just taking it at face value. And it really is about retraining your brain. So look at the mistakes. One of them is an example, and I still kick myself for this. It was the endowment bias. So if you're given something, you have an ownership to it, and so you're a little less rational with it. We'll have clients that will inherit stocks, and because they've inherited stocks, they don't want to sell it. Well, I was in New York for a concert, and somebody on the street, they were actually, raising money, but they came up to us and said, hey, would you like a New York hat? I'm like, sure, but I need two because I've got two boys. And then it was like, well, they're $10 a piece. And I couldn't give them back the hat because I had the hat. They were my hats now. I would not have paid $10 for these hats, but because I had them in my hand, I wasn't going to give them back. So looking in that and being aware of those things, and then taking the emotions out of them. We live in a world of rose-colored glasses sometimes. So looking at things realistically, looking at both sides, you'd audit trails, feedbacks, checklists, automate when possible. Look for multiple perspectives. I tend to be an NPR news junkie, but at least once a day, I will switch over to WLW, which is talk radio, and get a different perspective so that I'm seeing things from somebody else's. And my husband and I are definitely on opposite ends politically. So we play devil's advocate with each other. We think twice and we take an outside view. So any questions? Thoughts, comments, anything that you've experienced yourself?
I say, don't be shy, people, ask away. I don't see any questions.
I just explained it so well.
I know.
You did a very good job.
Yes, I agree.
Well, and I just, like I said, I just touched the surface, and behavioral finance is actually one of my passions, because we're not all rational, and if we were all rational, there would be no market, because we'd all put the same price on a stock or something, so there wouldn't be buyers and sellers.
So was there a lot of panicking last year at this time? I know you kind of touched on it, but was it pretty freaky?
For some of my clients, yes. For other clients, I mean, and part of it is we work with our clients. They all have financial plans, and we tell them that, yes, there will be downturns in the market. We plan for those downturns in your plan. So it's not a surprise to us. Things go down, they're going to come back up. And we have had several clients say, keep me in cash so that I can buy on the next downturn. Things are on sale, let's put them in the market now.
Okay.
I still have had those clients that, and it just tears me apart. I still remember one client, and it was probably 2008. We had them in a fairly conservative portfolio, but they were used to being in CDs, so they weren't used to market fluctuations. And they were getting very, very nervous. And I kept telling them, I said, just be patient. It's going to go up. It's going to go up. Well, they couldn't be patient, so they pulled their money out. The very next day, it started on one of those market runs, and it just really hurt me. And on the radio today, it just really upset me, because it was an advertisement for Rick Edelman Financial, and they have this downturn proof portfolio, but there's a limited number of people that can get into this portfolio. And the way that it works is you agree on how much you're willing to lose. And so if your stocks fall, they will sell your stocks so that you won't lose anymore. And then they'll work on getting you back in the market. Well, what happens is, our philosophy is you pick an asset allocation. So you have a little bit of this and a little bit of that and a little bit of this. Well, each segment grows differently, so you rebalance. So you take money from the winners and you put them in the losers. So the law of averages is they're if your bonds have run off and they're way out of whack, so you've got too much in bonds now, well, we'll sell some of the bonds and we'll put it in stocks, because the stocks have dropped. So you're buying them on sale. It's just very counterintuitive, but what this plan is, they're going to sell the losers and buy the winners. I just had a problem with that.
So don't listen to the radio, Jalene. There you go. Well, it doesn't look like we have any questions.
made perfect sense. I mean, if you're just listening to it, wow, that's a good deal. They're going to only let me lose so much money. I'm going to get some of that, and not
I'm going to
thinking
give them my money.
all the way through it, because they were keying in on fear and greed.
Yeah.
Oh, just one other thing.
Sure.
And I love this. And this is very nice because we've got this colorful little question marks there, but we have bull markets and we have bear markets, but right now we're in a bunny market, and that's because the stock market is going up and down and up and down and up and down. So
Okay, Jalene.
bulls, bears, and bunnies.
I like that.
Yeah,
Did you
I
make
do
that up
too.
yourself?
No,
No,
I stole
okay.
it from someone. So
Well, thanks everybody for being on tonight. We appreciate it. If you have any questions, Jalene's email is on that last slide. You can email her directly. Is that correct, Jalene?
yes, that is correct.
Okay,
So,
well, thanks everybody. Take care.
thank you.
Bye.
Bye.